Welcome to Markets Now. I'm Michelle Rook along with Steve Freed with ADM Investor Services. And we saw a higher opening in the livestock futures. We're still holding on to gains except for some of the back months in the hogs. Over in the grain trade, pressure in corn and soybeans this morning were mixed in wheat. And let's talk about the pressure first, Steve, that we're seeing in corn and soybeans. A lot of this has to do with the weather and at least a little more favorable weather outlook, right?
Yeah, I think the corn market has given up some of its recent gains because concerns about late planting. Looks like we're going to have at least a 7-day open window in the Midwest to get corn planted. And I think that temperatures warming up is a good thing also. Northern plains going to see a meltdown, which could delay some plantings there, and the southeast remains wet. I don't know if we're going to get that 92 million acres, but the market is less concerned about late plantings now than before. And then, the demand I think is good, but I think the market is just cleansing itself right now. And I think that once we get the corn crop planted, I would expect nearby corn to go back and try to rally up.
And you have told me, though, that right now the funds really don't have a reason to be long in the grains.
No, I think that the WTO came out and talked about slower global trade because of the war in Ukraine and because of inflation. They also downgraded global economy because of those issues. And so I think that continues to offer some resistance over the marketplace. And I don't think the funds, which have probably only an 80,000 total long in the grain room, I don't think they have any interest in buying grain unless there's a weather problem.
Okay, so you just mentioned that you thought after we got the corn planted that we might see a little bit of a run there. So why do you think that? What's going to cause maybe some of the funds to come back in here into this market?
I think our cash markets are very tight.
Okay.
We're seeing ethanol stocks drop as domestic gas use increases. We're still the only game in town as far as export corn is concerned until July and Brazil starts harvesting. And so I think that the cash is going to lead the way. And I think that's we need to fill the pipeline. The farmer wants $7 corn for old crop, at least $6.20 on the December for new crop. And I think we have to test those prices to get corn into the pipeline.
Is that the same scenario here for beans? I know you've told me that the spreads and the basis are actually going to probably do the work, keeping the old crop contracts supported in corn. Is that true in soybeans as well?
I don't think so. I think when we start giving up this time of year, July, November bean spread, it means that the nearby market is searching for demand. Whereas down in South America, the bean prices are cheaper out of Brazil to China than the U.S. And it's even cheap enough to bring some beans into the United States. And so down the road, if we're looking at the end of 23, 24, some of these oil plants coming on, I think we're going to have to import beans to satisfy that oil demand. And we've certainly seen board crush margins collapse from a high of 220 beginning of March to below $1 now. And so I think all these things are contributing to a weaker tone in the nearby bean market. And I think the emphasis now is going to be on the November. Farmer wants $14 beans for his new crop beans. And I think that if there's any weather problem, we're going to have to go test that level.
Yeah, because 87.5 million acres probably isn't enough if you have all of that domestic demand coming at the market. Right now, though, we've kind of switched over now where Brazil's harvest is coming in and China's going to switch over or has already to buying Brazilian beans, and they're cheaper than us right now, aren't they?
Yeah, and I think the only thing that was kind of unknown was Argentina, but they have a soy peso deal that probably farmers will sell 8 to 10 million tons. They've only sold 5 million tons to date, and last year by this time they had at least sold 12 million tons. So I think that between Brazil offering cheaper beans to China for crush and Argentina going to be selling some beans, all those things offer resistance to the nearby futures.
Yeah, and that soy peso dollar in Argentina you talk about also has been weighing on the meal market, hasn't it?
I think more importantly is the fact that domestic meal basis is softening, and we've seen a collapse in the May, July meal spread. And so I think that's a little bit more important. We're seeing a little bit of export meal going to Europe with DDGs. That probably the meal would have been coming out of Argentina. But I think if we keep the crush where it is and eventually down the road start crushing for oil, then I think the meal will continue to be on the defensive unless there's a weather problem.
Okay. Do you think that it's possible that we will have some delayed planting that will mean we'll have prevent plant? Maybe we won't get all those soybean acres planted, Steve, or not?
I think we'll get all the bean acres planted. I mean, when you drive around the country and see some of these 36-row planters, 2 in a field, I think that you'll get the crops planted. I'm not worried about that. We always get the crops planted. It's just, July and August weather that is the key after the crop is in the ground.
Gotcha. So what about the wheat market? We're seeing spread trade, Chicago lower, Kansas City and Minneapolis higher. We had 50-year lows in terms of spring wheat planting intentions in the report the other day, but we also see HRW conditions very poor. Where does the market go from here with all that in mind?
Well, right now, the USDA is forecasting that 44 million tons of wheat will come out of Russia versus 33 last year. And that's been a very strong defensive in the wheat market. But right now, half the market is trading weather, with the American model yesterday and the European model both agreeing that the Southern Plains is not going to see a lot of rain. It may rain in the eastern part, but not the western part. Also, the meltdown in the Northern Plains will probably reduce spring wheat acres planted even more than what the USDA said. Now, when we look at globally, every exporting country, U.S., Canada, Australia, Russia, will see lower supplies in 2023, 2024. But the only country that's going to see an increase is Europe. So we continue to see Europe prices, Matif trading quite a bit lower, as there's just too much wheat there. And so I think that the market, once it realizes that supplies from an exporter standpoint will be tighter, we'll see a bounce in prices. But we need to see the dollar lower, and we need to see some of these North African and Middle East countries pick up their buying pace. And so hopefully, they'll be able to come in and buy the wheat that they need. And maybe if they buy from Russia, other countries will buy from us.
Okay. We are also going into another WASDE report next Tuesday. So talk about how the lower quarterly stocks will get worked into the ending stocks for both corn and beans.
Well, I think that, again, the USDA is a conservative animal. And so they should lower the corn carryout because of higher domestic use. They probably have overstated last year's soybean crop, but they might not reach the export number that they have plugged in. So you hear people as low as 170 on the bean carryout, and other people unchanged at 210. And then you see for 23-24 a big increase in the bean carryout. Same thing in corn. They could probably lower the corn number marginally. But for 23-24, assuming we get a normal crop, we could be back close to 2 billion bushels. Not much change is expected in the wheat. Again, by class, spring and hard wheat might get tighter than soft wheat. But I think that this WASDE report might be a little bit more on the conservative side rather than what we were trading at the recent highs.
You bet. And then will they make adjustments on South American production or not?
I think, we're talking about the potential of bigger Brazil soybean and corn numbers, and they probably will reduce Argentina. But when you look at total South American, especially soybean production, it's going to be higher than last year. And they're going to have higher exports than last year, but their crush is going to be down. And so I think that 16 million more tons available out of South America to be exported is a negative factor that the soybean market is going to have to trade, and then we trade weather.
Okay. And just quickly on the meats, as I mentioned this morning, we've seen new contract highs in cattle with this big push in higher in cash trade. how long can you keep this going before, demand gets squashed, or will it? Because right now it seems to be supply tightness that is really pushing this market.
Consumers, I've seen a couple of companies talk about how consumers are buying less but paying more. And so they have to choose what they are buying. And it's more of a lower quality beef than what they're used to. But in China, the high class, upper class, richer Chinese people love our high cut beef. And so if that ever got into the retail side, there's just not enough beef. And I don't know if people domestically are making money as far as cow-calf and feedlots, but globally, I think the demand for our meat is good. As far as the hogs are concerned, there's too many hogs. A lot of exporters. Russia is holding the key. Mexico is probably holding up the hog export market, but there's just too many hogs. And I think that that's something that you can see by people continuing to see cattle gain on hogs as far as futures are concerned.
All right. Well, always a pleasure to talk to you. Steve Fried with ADM Investor Services, and that's Markets Now.